the job, you need relief. The way they see relief, though, is much broader than that. They see it in relative terms as well. Because of the K-shaped recovery, if you had assets, you did really well. If you didn't, you got left behind. And they think there needs to be some relief on that as well, Tom. So it's relief in absolute and relative terms. It's far, far too nuanced right now, but that's the debate that's taking place in D.C.
I go to a 3-month moving average non-farm payrolls with revisions. The revisions were lousy last week. The statistic was lousy last week. March 5th is critical.
No one disagrees. More work still needs to be done. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. More to come on this debate with James Sweeney, the Credit Suisse chief economist. From New York City for our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
Do you have any interest if President Biden invited you just to come and take a tour of the White House just to see what it looks like?
If he wants to talk about how to empower people, boy, I would be there in a nanosecond.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on TV and radio. Let's get straight to the price action of this morning. This equity market Doing nicely, a 5-day winning streak coming into Monday to start a new trading week. We have a lift. We're up about 1/3 of 1% on the S&P 500. On the NASDAQ, up by about 1/4 of 1%. It wasn't big tech that dominated the headlines last week, though. It was in the financials. And I want to get to the why very quickly. Switch up the board and get to the bond market. 10-year in Germany, in the United States, a lift on a 10-year in the US, just south of 120 earlier on this morning. That right there is a post-pandemic high on a 10-year Treasury yield. And just lifting things a little bit as well. The anchor of the global bond market, the center of gravity, that's what we like to call it anyway. The bund yield coming with it as well. Just up a little bit, less negative. Your German 10-year, negative 43 basis points. This bond market setting the stage for a monster rally in bank stocks last week. Let's take a look at what it looked like over the previous week. JP Morgan, Bank of America, Citi, JP up 6.5%, Bank of America up 8%. This cyclical trade back in vogue, and this bond market supportive of it. And I think in the equity market, that'll be a focus for me at the open a little bit later this morning. With more movers for you, our good friend, Romain Bostic. Hey, Romain.
Hey, good morning, John. A little bit of a snooze fest here in the pre-market, illustrated by the fact that the biggest mover right now is an insurance company. Heartless, I know, but CNA Financial up about 13%, beating earnings, so seeing a little bit more activity in the chip space. So interesting deal out there by Japan's Renesas buying Dialog Semi, sort of the UK German chip manufacturer. It's a foreign deal, but it has a lot of implications for companies here in the US. You're seeing On Semi, Cirrus Logic, and a lot of the names based here in the US rallying higher. The idea here that you need to see some consolidation in this space and this latest deal overseas, that might actually be a catalyst for some deals going on here in the US. And I know you guys been looking out for this, all the speculation that we've been talking about last week about Apple and that Apple car. Apparently that's not going to happen, at least not with Hyundai and
that's
Kia.
like going away.
What's that?
It's gone away.
I think so. So I hope you didn't put down that deposit just yet, Tom. But it could come back in 2024.
He moved it all out of the triple leverage cash into the Apple car. So you're dashing his hopes. Go on, Romain.
Dashing his hopes. All right, we'll save your tears. Flip up the board. Let's take a look at the party monster from last night. Viacom, CBS. Of course, a lot of people keeping an eye here on the ratings from last night's Super Bowl. Keep in mind, though, this is a stock that's rallied about 45% this year, sort of into that. So any big bump that you see in ratings there, that might already be priced into the stock. Maybe why you're seeing it drop a little bit here. Let's go down to the balloon party at Hasbro. They did beat earnings here overnight. So you're seeing a little bit of a bump there. And crypto, I know your favorite topic here, back in the news here. Bitcoin, Tom, it's above 40,000, or at least it briefly got above 40,000. So you're seeing MicroStrategy, some of the equity proxies for Bitcoin move a little bit higher. And if Bitcoin isn't speculative enough for you, Tom, you can always check out the Doge.
Very good.
All right.
The Doge.
Yeah, record high.
Romain, thank you.
I can't feel my face.
I'm running out of time.
Yeah.
Because I can see the morning.
Is that what it's called?
Here. We can see the
Doge.
morning light
Doge.
with James
That's
Sweeney.
what they call it. Really?
Yeah.
The
I
Doge.
didn't know that.
It's very Venetian. James Sweeney with us with Credit Suisse. His wonderful call a number of years ago, fear not of deflation. He joins us now, the chief economist for Credit Suisse. James Sweeney, should we fear inflation?
I don't think so. I think we may get it. I think the risks of inflation, of higher inflation down the road are certainly going up with all this policy. But I'm not sure there's anything really to fear there.
Well, there's not the fear there, but then there's the rate of change and Newtonian analysis of all this. I mean, I don't really see, I do see the vector of 5 years. I get it. It's an impulse higher inflation. But do you see a rate of change that causes concern?
I don't. I think where the global fixed income market is leaves supply and demand supportive for lower long-term yields. So I think they can go up, but I don't think they're going to go up 100 basis points. I don't think they're going to go up enough to imperil a housing recovery or anything like that.
James, I assume you read the piece from Larry Summers on Friday into the weekend and this huge debate everybody's having right now. Can you weigh in on that just a little bit more for us, James? Your take and where you sit on this discussion right now?
Well, I mean, I've been looking for the package to come down from 1.9 trillion. Now, 1.9 is very large. So, you know, this is stimulative relief. It's stimulus and it's relief. And I think when we look ahead to next year, I think it is realistic to get back to full employment in 2022. We're going to have a little overshoot in inflation in the coming months. It is possible that we have inflation running above 2%, maybe a decent amount above 2% for the next 12 months. We'll take it. I mean, these are good things. So I think, yes, we may get overheated. We may get very volatile markets. We may get a cyclical whipsaw in the economy. So you're putting more cyclicality into growth. So there's a lot of volatility in a bill of this size, but volatility is not, a significant cost given the objectives involved here, which is really to get the economy back to full employment and maybe to soothe some of its distributional consequences.
Do you take issue with size alone, though, James, or is it the composition of it as well?
Well, composition is quite important. And actually, I would say, I think about this as part one, because it's clear that when this gets passed, the administration is going to start focusing on a long-term stimulus bill with green energy and infrastructure and all that. So there's a balance between immediate stimulus, how much cash drop is in that immediate stimulus, and then what is the long-term implication, including the later package? Because I don't think you can think about the results of this bill and the politics of this bill without realizing what's up next. So these are all big things, and this is a major increase in the projected growth of the economy in the next few years if both of these bills get through, and even if this one just gets through at a 1.9 trillion size or something close to it.
James, let's talk a little bit more about composition, and I want to follow up on something John was talking about. He rightly identified the way that Democrats are painting the $1,400 checks is something perhaps a bit more than just relief, but also evening out that K-shaped recovery. It is a very important point. Is the Democratic Party framing this wrong? Is there a cleaner economic argument for the money to be going to lower income families in that they will be spending it more and more quickly, whereas if you have a certain threshold, a certain cutoff that's even known, that will go directly into savings?
Well, it's clear this at 1.9 trillion or even a little bit below that, this is going to be enough money to boost savings, to boost current spending, to help balance sheets, and to boost future spending when we finally get into a proper services recovery. I think the distribution of this, especially with the payments, is going to be a very large improvement in the short-term prospects of people with, the bottom half of the income distribution. How they emphasize that, I think that's a political question. They're just trying to get it passed. I think the beneficiaries of those checks they don't care about, the political operations and how they get it through. They just want to get it through. They want to get this check, and they want to get through this pandemic and get on to normal life again later this year.
James, do you agree with what Janet Yellen was saying over the weekend on Meet the Press when she was saying that if they pass this bill, we could get to full employment by perhaps next year?
I think we can easily get to 5% unemployment by the end of this year with this bill. And I think late next year, 4% is within reach. I think full employment is around 4%. So I think it's a reasonable thing for her to say, yes. And like I said, I think that next fiscal bill is going to be right around the corner. I think in 3 months, we're going to be talking about green energy and infrastructure. So this is really just the start. So the question then is, how do financial markets start to move in response to all that? Do we see meaningfully higher interest rates, inflation, et cetera? So this really is changing the macro outlook very substantially.
James, what is the inflation partition? Services and goods, what's that dynamic right now? What do you foresee it to be in the next 12 months?
Sure. Well, right now we've had a larger jump in goods inflation than services inflation, because for the obvious reason that goods spending has been very strong. Services spending remains lackluster due to the pandemic. We've all heard about this base effect coming in the next few months. So core inflation measures really around the world are going to be going up into June, but actually it's going to be more pronounced at this goods versus services level. Goods inflation, non-services inflation is really going to jump. PPI inflation measures, looking at intermediate goods, things like that, are going to really jump in the next few months. As we get into the end of the year, maybe there's going to be shortages of restaurant tables and flights, and then you can actually get some services inflation. But we need a pandemic recovery for that relative price shock to start to switch around.
James, awesome to catch up, as always. Good to see you, buddy. James Sweeney there, Credit Suisse chief economist. Tom, straightforward, intuitive economics. The point Lisa made is a valid one. Low-income households have a higher marginal propensity to spend. We all understand that. How you define a low-income household, though, I think the Democrats are opening up something that could be Pandora's box here. The $75,000 issue. Is that enough as a household? Now, Tom, from my standpoint, my perspective, I'm not here to advocate for either side of the argument. What I think is important here, if you start to communicate to the electorate that $75,000 is not sufficient, to raise a family in the United States of America. If you start to tell the electorate that those earning $75,000 have been left behind because of perceived social injustices, at least the perception of the Democratic Party right now, Tom, I don't think you can move away from that after the pandemic. I think that's something that lingers and becomes a political hot potato that the Treasury has to address.
There's two ideas there. It's always been there, but what's interesting here is the urbanization of America, which has been going on for decades and continues to this day, where you really get a question of can 75,000 be enough to raise a family with X number of kids? But the other, John, is a use of credits. The way this is typically done are direct tax credits which benefit directly the poor who need it. And there's been a huge reticence to reinvigorate the credit debate of the 1960s. I just don't see it out there right now.
Well, Tom, it comes back to wealth inequality, and that's what they're trying to address. And Olivia Blanchard was trying to say, do it through capital gains. If you want to do something about the people that held assets and did really well through the last 12 months, you could do something through capital gains. There's other ways of doing this, but that debate, I think, is really getting fired up down in D.C. It won't end after this package is passed. In fact, it will ramp up.
It's a debate, Lisa, of a Democratic president, a Democratic House, and a Democratic Senate. That's what's changed the debate.
Yeah, that's also changed the debate is the student loan outstanding that's gone up to $1.6 trillion. The fact that housing prices have gone up disproportionately. This idea that base aspects have gone up in price. I will say there is also this fast-moving experiment that we're living in, John, and I think that you can't underestimate that we don't have data showing what that cutoff is. I think the amount of studies that have been coming out to understand who's spending it most, how it's going into savings, how it's going into the economy, will lay the foundation for a lot of economic arguments to come.
Couldn't agree more. There we go. We're on the same page.
That's a first.
Kumbaya.
I'm not here to advocate for a policy.
Let's hold hands.
I think we've just got to talk about the questions that are being raised, and I think they're really, really important questions. Do you want to put that hand up again?
Sure.
Tears from Tom Keene.
We're all on the same page.
From New York City. I think that's the first time I said that in about 5 years working with you, Tom. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. Treasury Secretary Janet Yellen is making her case for Congress to pass the Biden coronavirus stimulus plan. Yellen says the U.S. can return to full employment next year if the package is enacted. Without the stimulus, Yellen says it may take until 2025. Republicans argue that the plan is just too expensive. Donald Trump's second impeachment trial is almost certain to end in acquittal, but still it will deliver a public reckoning for his presidency, and it will influence whether his populist supporters continue to dominate the Republican Party. The impeachment trial begins tomorrow in the Senate. And UK exports to the European Union have fallen as much as 2/3 since Brexit. That's according to a truckers group, which says trade is being held up by new red tape. It also says that up to 75% of trucks that are from the EU are returning empty because there are no goods for them to transport. In London, Brent oil rose above $60 a barrel for the first time in more than a year. It's another milestone in a remarkable comeback from the biggest demand destruction in a generation. The coronavirus pandemic led to lockdowns and grounded planes. And in sports, Tom Brady is still super. The 43-year-old quarterback guided his new team, the Tampa Bay Buccaneers, to 31-9 win over the Kansas City Chiefs. In the Super Bowl, it was Brady's record 7th Super Bowl win, and the other 6 were with the New England Patriots. He threw 3 touchdowns and was named the game's most valuable player. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
You need to have a business model fundamentally where when you do well, the world around you is doing well. If that is broken, it's very hard to fix.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
I think it's time for schools to reopen safely. You have to have fewer people in the classroom. You have to have ventilation systems that have been reworked. Our CDC commissioner is going to be coming out with science-based judgment within, I think, as early as Wednesday as to lay out what the minimum requirements are.
President Joe Biden speaking with CBS over the weekend from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Counting you down to the opening bell, let's get some price action for you quickly. We had some weight to the S&P. All-time highs. 5 straight days of gains, could become 6. On the S&P, we advance on the S&P 500 by a couple of tenths of 1%, call it 12 points, up by about a third. In the bond market, just a little bit of a lift, Tom, on Treasury yields, taking us to the post-pandemic highs of the last 9 months or so.
Some stasis right now, but general lift here as we get to the market opening here. What is that, 2 hours away? Right now, Robert Murphy joins us. He's with Northwestern. And what he is acclaimed for is longitudinal studies. This is to look at studies over the lifetime, over the period, in this case, of the pandemic and of this horrific virus. I've been talking, Professor Murphy, about the everyday of it. I've been looking at the x-axis of just every day adding to vaccines. Is that a linear trend, or does it accelerate into a common benefit?
I mean, the administration of the vaccines?
Yeah.
Yeah, no, it's pretty linear at this particular point. You're not going to, it can't get exponential until there's more vaccine available. And that's not going to happen until May or June.
So if we have a linear trend, a day after day grind, when do you perceive that the vaccine clicks in as a complete societal benefit?
Well, in the United States, that is going to click in, like I said, in the late spring. And then there's going to be vaccine available for anybody that wants it if they can find a place just to get it. Then the problem we're going to have are the people that don't want to take it. And that is going to be the bigger problem. So we're going to go from too little to too much, and the people that are hesitant to take the vaccine. Because if we don't get up to that herd immunity thing, this whole thing just keeps going.
Yeah, and Dr. Murphy, as this whole thing keeps going, we are watching that variant from the UK start to accelerate in certain places in the United States. I'm thinking in particular southern Florida, Miami, where that is starting to really account for a greater proportion of the virus cases that have been diagnosed. What is the likelihood of that becoming the dominant strain in the United States in the near term and causing a bigger hurdle to get over the hump and get beyond the pandemic?
It's happening, and we can't stop it. It's the number of, even though we're not testing very much here, we are testing a sampling. It's doubling every 10 days. So double, 3 times is going to double every month. That adds up. And the projection now is that by March, it'll be the dominant strain.
So, Dr. Murphy, there have been conflicting reports on whether this is a more virulent strain. Some studies have shown that there is a higher incident of more severe illness. Based on your research, how much more damaging is this one?
Well, this one, definitely it transmits faster. And this is why you hear, oh, wear a double mask, upgrade your mask, keep with the social distancing, even if you had the vaccine. That's what it's all about. It spreads easier. There's actually no question that it spreads easier. What was very disturbing, what came out of the London School of Tropical Medicine the end of last week, is that they are saying that it is actually more lethal by about 30 or 40%.
What does that mean for our viewers and listeners? This idea of lethality is really front and center, but how do you as a grizzled pro describe that?
Well, it's easier to just look at a hard number. You know, you're talking about in like Illinois, my state, you know, we're having like 3,000 new cases every day still. And we're thinking, oh, we're happy because it's not 10,000. Well, of that, of every 1,000, approximately, it used to be 10 people would die. So 10 out of 1,000. Now it's going to be 13 or 14 people, if this is correct. Now, we have that data is not verified yet, and they admit that. But, you know, it's suspicious.
Dr. Murphy, based on how quickly that variant is spreading, what is the percentage that you estimate of the population that needs to be vaccinated for us to reach herd immunity?
Well, I mean, I'm just going to tell you what the estimates are, because nobody knows. We won't know until actually it happens. And at the same time, we're in the collision course with the variant, which makes the vaccines not work as well. Now, with this British variant, the B117, they work pretty good. So, you know, that should be okay. But the South African variant and the Brazilian one, that's a completely different story. As you probably heard, in South Africa, they stopped the rollout of the AstraZeneca vaccine because it worked so poorly. So anyhow, we have this collision happening here, and it's going to be somewhere probably in the 70 to 80% range.
Doctor, appreciate your time this morning. Sorry, we've got to leave it there. Thank you very much for being with us. Dr. Robert Murphy there of Northwestern University. Need to change track just a little bit and get to this market, but not where you think I'm going to go. Bitcoin, Tesla invested a total of $1.5 billion in Bitcoin under a new policy. Top King, Bitcoin to the moon, up another 8% in today's session.
Yeah, nicely moving up, almost printing 42,000. But the key headline of a set of headlines here is to accept Bitcoin as a form of payment. And I find that extraordinary, John. That would be a huge leap into commercial use of Bitcoin, buttressed up against government worries about the transparency and the documentation of Bitcoin.
So transparency and documentation is the big issue, Tom. We can't get away from that too quickly. I will say, though, the institutional buy-in over the last several months is really, really important, because one of the biggest problems with Bitcoin is just the volatility of it. That's why many people would say it's not a useful currency.
It's not a currency. Absolutely.
Totally.
Yeah,
but Tom, if you get more institutional buy-in, what do you get? It should dampen the volatility a little bit.
Yes.
And then the use case starts to build a little bit more, Tom.
Well, I totally agree with that. And, you know, we don't need to get into all the dynamics of pro or anti-Bitcoin. But to me, it's just incredibly important that you're going to do a $30,000, $40,000, $50,000 transaction routinely.
Hold on a second.
With Bitcoin.
Let's just provide a little bit more context to what they're saying. They said that they expect to begin accepting Bitcoin in the near future as a form of payment on a limited basis, subject to applicable laws, and initially on a limited basis. So they may also liquidate this right after. It's still is a question how much this will be used. Nevertheless, it is interesting to see it used for a commercial use. One thing I am not hearing about, though, is Bitcoin being allowed as a form of payment for taxes. And that's a big issue, especially, John. There was a report about how the U.S. confiscated somebody's holdings of Bitcoin and then couldn't get it because that guy would not give the password. I mean, there's a lot of
the bottom line is, if you can't pay your taxes with it, it's not a currency. I totally agree with you. But if you can take out some of the volatility, the transactional benefits really get boosted. And I think what you're hearing from Tesla right now on the treasury side of just managing cash over at a corporation, Tom, I think is quite interesting. They may invest a portion of cash in alternative reserve assets. Now, Elon Musk is a blue sky thinker. I understand all of that. But someone has to move first, Tom. And you wonder who goes next.
Well, you wonder who goes next. But again, John, I'm going to go back to what we hear from Professor Rogoff, Professor Rubini, and others. Where is the transparency, the trail of transactions visible to governments?
Totally agree.
There.
That's the problem.
It's not there.
From New York City this morning, good morning. Alongside Lisa Abramovitz and Tom Keene, I'm Jonathan Ferro. Your equity market at all-time highs, and we add some weight to it, up 1/3 of 1% on the S&P. This is Bloomberg.
Animals across the globe are dying by alarming rates. A report by World Wildlife Fund and the Zoological Society of London found that populations of mammals, birds, amphibians, reptiles, and fish fell by 68% in the last 50 years. In the tropical Americas, the rate was worse, with a 94% decline in the same period, and the size of observed wildlife populations in or near freshwater globally have fallen by 84%. Continued human abuse of the planet may lead to the collapse of the systems and resources that allow global civilization to persist in the first place. Overfishing and hunting, invasive species, pollution, habitat loss, and climate change are the main causes of this animal population crash. The report compiles evidence from 4,392 different vertebrate species and concludes the evidence for humanity's destruction of biodiversity is unequivocal. Using powerful computer models to simulate policy that stops biodiversity loss, scientists have explored scenarios to slow the trend. Such measures would include expanded conservation, increasing agricultural yields while also eliminating food waste, and cutting the global meat intake in half. By changing what the world eats and how it produces that food, nations could stop this tragic loss of life by almost 50%.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport industry
buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
New order placed to sell short at 120, 28.5. Euro against United States dollar.
At some point this year.
There is still a lot of scope for scarring in the labor market.
What we have, though, is a very big cushion that's been building in excess savings.
The virus dictated the downturn, and it will dictate the pace and the shape of the recovery as well.
A lot of the U.S. stimulus actually isn't stimulus at all. It's an antidepressant.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a simulcast. It's a Monday in New York, snowy New York as well. We welcome all of you across this nation on Bloomberg Radio, on Bloomberg Television as well. Lots of different story threads in this hour and in moments. We're really going to dig into the government, inflation, interest rate dynamic. We do that with futures up 12 and yes, yields higher as well. Bitcoin on it. John, just between my fourth cup of coffee, Bitcoin went 40 to 43,000. We could have 50,000 by when we're done speaking with Rosenberg.
Tesla getting involved, Tom. Cash management, maybe transactions as well at some point in the future. Yeah. And I think institutional buy-in is really important. It's what the bulls have been waiting for. They got a taste of that this morning.
Bitcoin up 15%, up 5,700. Now, John, let's get back on the script right now. It's really important to set up the guest for the hour where the script is not so much higher interest rate, but the speed of higher interest rates.
119.81, that's your number, Tom. Post-pandemic high, U.S. 10-year Treasury yield, and it happened this morning. Chairman Powell speaks on Wednesday. I wonder if he carries on giving the green light for what we're seeing at the long end of the curve. 120, maybe that's not a problem. When does it become one?
Absolutely nailed it, John. And I've said this and I've said it again, and we've observed this from time to time. It's not only a speech that someone gives, but it's a whisper, a line here, and then somebody else, a whisper and a line there. You wonder how many whispers it will take to get some form of what I'll call Fed angst.
Keep hearing that policy is in a good place.
Yeah.
Maybe that's the line they keep to, Tom, but at some point that...
Short position open on euro at 120, 28.5.
Report, and that's a huge deal for Washington.
Yeah, and it raises this question, especially for the Federal Reserve. Is their allowance of asset prices to continue to go up despite some of the concerns about froth and the lack of perhaps corresponding fundamental data? Is it actually helping the employment picture, right? Is it getting them closer to that goal? And it sort of goes to this idea, if we have faster inflation expectations at a time when we also have asset prices that are going up because you're not seeing the commensurate rise in Treasury yields, at one point, will Federal Reserve officials get uncomfortable, Tom?
I want to get the data out of the way. It's correlated, everything but dollar really moving. And again, Bitcoin up 15%, 43,400, almost making it out to a 44,000 level. Futures up 13, Dow futures up 129. VIX doesn't give me too much information yet, 21.25 in the VIX. Bond, John just dropped through the bond market, 1.18% on the 10-year. And again, currencies, John, I mean, currencies aren't giving me much love this morning.
Well, I will say, Tom, let's build on this. I think what we're seeing play out, particularly in the last couple of weeks, is a U.S. bias that's returned to this market.
Yes.
A focus on a fiscal plan that's bigger than anything we're seeing anywhere else. A focus on a vaccine rollout that I think the average daily rate over the last 7 days is getting closer to 1.5 million, the president's updated target. And a lot of people focusing back to the benefits of staying U.S.-centric, so to speak, Tom. When we finished last year, we were talking about EM, maybe throw in some Europe. I don't hear many people throwing in some Europe over the last month.
Yeah, finally a pullback, John, in Bitcoin. We're from 44,000 down to 42,004. We'll watch that through the day. It's sort of like it's like a GameStop thing. GameStop, I saw at a 70 level.
We'll get some nice emails shortly comparing Bitcoin to GameStop.
Thank you. Right now, partitioning for us inflation is a gentleman who's done that best. He's in my book from years ago, David Rosenberg, of Rosenberg Research, and we're thrilled he could join us today. David, when you partition our present inflation and our expectations of inflation, what do you see?
Well, look, what we see is the break-even levels in the 10-year Treasury, getting as high, as they were practically, getting to the peak of the last cycle. So, we're already well above 2%. and the market is pricing in, not just a significant economic recovery, but alongside that, the closing of the output gap earlier than expected. And these inflation expectations, I mean, they've caught me by surprise how quickly the market is priced in an inflation cycle so quickly. I think it's way overdone. But, the big question isn't so much the $1.9 trillion.
Right.
It's really ultimately how much of that $1.9 trillion filters through into the economy. And I would have thought, actually, that the markets would have recognized the survey that the New York Fed did a little while ago following the CARES Act that found that only 29% of that stimulus found its way into the economy. The rest went into savings, I guess you could say, in the Bitcoin and the GameStop and the stock market.
Yes, I did.
Savings. The rest went into debt pay down. What I can't correlate is this, in terms of the market mindset. How are we going to get inflation as the household sector is deleveraging, unless the market thinks it's temporary?
David,
household demand for bank credit is running negative 3% year over year. Negative 3%.
Okay,
households are paying
David,
down debt, and people think that's going to be inflationary.
You're taking a different tack. Can you buy bill notes and bonds today? Can you buy today for price up, yield lower?
Well, I think we're heading into a very attractive buying opportunity at the long end of the curve. I mean, if you're bullish on bonds, I'd be heading towards the 30-year, which, as you said, touched 2% today. The bottom line here is that the Fed is not going to be tightening policy for a long period of time, so there's no risk that the cost to carry is going to go up. The big debate is really is about inflation. But you've got a market right now that's priced for inflation heading to the peak we had the last cycle, core inflation. And I think that's going to still be very difficult to achieve, even with the fiscal stimulus.
David, let's build on this. When we're talking about inflation, as you correctly point out, we're talking about market-based inflation expectations. How useful are they, David? How useful have they ever been, given where we are right now? How do you move 10-year inflation expectations based on what's happened in the last couple of weeks?
Well, look, the biggest correlation between the break-evens is with the CRB index. And of course, that's real-time data. What people don't see is that the biggest component of the CPI and core CPI is rents. And vacancy rates are going up, and rental inflation is melting, and that's going to be dominating. But the rental data don't come out as quickly on your Bloomberg terminal as the CRB index. And we have a commodity boom going on. But we had 4 or 5 of these commodity cycles just in the previous 10 years. And that cycle from 2009 to 2019, we had 4 or 5 incredible, they look like sine waves. And people get caught offside because they believe, oh, we're going to get inflation's around the corner. And then what was the dominant feature of the last cycle? Did we get cyclical inflation? Yes, we got some of it. But the bigger picture is that from 2009 to 2019, despite all the gargantuan fiscal stimulus we had and all the monetary stimulus we had and a quintupling of the stock market, the peak in core inflation last cycle was 2.4%. To me, the big picture is that you got to go back a century to find the last time core inflation peaked at such a low level. And we're getting to the break-evens heading back to that right now. So I think that's a great buying opportunity. The market right now is pricing in peak core inflation from the last cycle when the unemployment rate was 3.5%, not 6.3%. So to me, this is a great opportunity to get back into the long end of the curve.
David, to build on what John was talking about, there's a difference between inflation expectations and actual belief in inflation that's being borne out throughout markets. How consistent is the reflation trade throughout all asset classes, or is it mostly tied to break-evens and a specific subset of the market?
Well, look, I think that you're seeing it across, a broad array of asset classes. I mean, you've got the reflation, inflation trade in small cap stocks. You're seeing it in commodities. You're seeing it in how value has outperformed growth for the better part of the past few months. So it's not just in the bond market. The inflation expectations, and I've only been fielding calls now in the past couple of weeks over whether the inflation story is going to be the real story. I think it's to me it's a head fake. I think that the surprise will be that the inflation doesn't come back as quickly as people think, but it's really endemic across almost every asset class you're seeing right now.
Really looking forward to getting you back, David. Always enjoy catching up. Thanks for being with us this morning. David Rosenberg there of Rosenberg Research. In your market right now, market-based inflation expectations are building. Tom, the cyclical trade is back on. The reflation trade, is back on after stalling a little bit into the new year. The question you have to ask from a market's perspective, what are the sources of upside surprises from here on out, given what we're pricing in before we even reopen?
Well, yeah, and again, it's a linear function. I want to make clear, folks, inflation expectations, without question, have a certain oomph to them as well. But John, you know, you've got a consensus view, and then you've got 8 flavors. Oh, wait a minute, it's not going to happen. And clearly, Chairman Powell is in the Rosenberg camp, where he just doesn't buy the immediate urge to be fearful.
Well, I think the Fed, Tom and Lisa, you'd agree, just willing to look through this and willing to look through it for a while.
Yeah, although there is a concern. If David is right, if inflation expectations are too high, what does that mean for broader markets, given how much of a consensus the reflation trade has really become? And, you know, you have to think, added to his argument, is the amount of debt that we have incurred, not only on a national level, but also on a corporate level, John. I mean, that's a dampening factor for growth going forward.
Lisa, you know how this works. It's about market biases and just perception. Yields up right now, good thing. Yields down right now, good thing. Good thing. Good thing.
Well, look,
that's how this market sees things right now.
And right now, JP Morgan did a correlation showing that when bond yields rose, stocks really have been unfazed. So it really has been a solidly good thing and not necessarily a headwind. But at a certain point, John, you have to think, when are we going to actually see that consequences of this reflation? At what point will the proof have to come from something substantive rather than hopes?
Do you like that? I got that from Tom. Hand actions on radio, Tom.
It works
up,
good.
Thing.
Yeah.
Down.
It works
good. Thing. Do you
Radio
like that?
loves it. Yeah.
I love.
We're good at that. I like. I
references.
was doing that deliberately to get you to do it as well.
Drive careful out there. We should say drive careful out there on radio.
I'm placing a stop on profit for euro at 120.26.5. Just right here. Okay. The stop on profit.
You know, you get down to -5.
It was 1920.
It's like a beginning.
1922. I remember it well.
Oh, my goodness. Tom, you'll do your John afterwards.
-21, Plymouth, New Hampshire. Colby Stone.
This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Treasury Secretary Janet Yellen predicts the U.S. can return to full employment next year, but that's only if it enacts a strong enough coronavirus stimulus package like the one proposed by President Biden. Yellen told CBS the job market is in a deep hole. Republicans have complained that the president's plan is just too expensive. President Biden promises a different kind of relationship with China's Xi Jinping than Donald Trump had. The president told CBS News there will be competition but not conflict between the two nations. He said there's no particular reason why he hasn't spoken with Xi yet. Bitcoin rose to a record price of more than $43,000 today after Tesla said it had invested $1.5 billion in the world's largest cryptocurrency. In a filing, the electric car maker said it may acquire and hold digital assets from time to time. Tesla also says it expects to begin accepting Bitcoin as a form of payment in the near future. And former U.S. Secretary of State George Shultz has died. Shultz led Cold War diplomacy under Ronald Reagan for more than 6 years and frequently clashed with more ideological members of the administration. Before that, the Ivy League-educated economist was Labor Secretary and Treasury Secretary under Richard Nixon. George Shultz was 100 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We're currently expecting the first quarter of this year to look pretty much like the fourth quarter of last year. So we haven't really seen, or we're not expecting to see much sequential improvement in that period. But hopefully, as we get into the summer and beyond, we start seeing demand rebound.
What a tough time to be an airline. That was Robin Hayes, JetBlue's Airways CEO from New York this morning. Good morning, Tom Keene. A little bit later this year, JetBlue, they're going to go from the United States into London. What a time to launch that.
Yeah, they're going to do the Mint thing in London. I haven't really researched it, John, but I'm crushed that they gave up the 747 on British Airways. To be honest about it, but JetBlue's being really entrepreneurial there. But you nailed it last week, John. The airline recovery is just not happening.
Tom, when it comes to the sequencing of this reopening, it's shifted in the last month. Travel and international travel won't be opening for a long time.
I mean, to be honest, folks, John lived this down to Capri and Naples, and then you went over to Miami and Key West. And, John, the fact is internationally, it's not working.
Do you want me to reply to that? Am I responding? No. I'm letting that go.
Let's talk about the gas that these planes use, Tom.
Yeah, let's talk that nicely. So you nailed that, Segui.
The adults in the room.
On radio and TV, the grown-up did the Segui well. Futures up 14. We're watching Bitcoin 43,000. Amrita Sen is a joy to speak to with energy aspects. What she does better maybe than anybody out there is the elasticity, the responsiveness of supply and demand worldwide. She joins us this morning. Amrita Sen, I think you nail it with demand elasticity being an absolute mystery. How much of a mystery is it right now?
Oh, it continues to be a mystery. I don't think COVID has really helped the situation because, even when you had 90% of the world's manufacturing down or industrial production shut in, this was around March, April last year, oil demand only fell by 20%. It does show you how inelastic oil demand is. Right now, globally, oil demand is down about 5 million barrels per day year on year, which again, given the scale of relative lockdowns that we're still talking about, even in places like China, it is doing very, very well. I think the cold weather has also really helped. We've seen LNG prices in Asia hit record highs, and as a result, a lot of power plants there have switched to liquids, so fuel oil, LPG, That's been boosting oil as well. And now, of course, in Europe and US, you've also had a cold blast. So there's definitely support for heating fuels. That's potentially masking some of the weakness elsewhere. Like, you guys just talked about airlines. Jet fuel demand isn't recovering anytime soon. But I do think the colder weather has helped at least mask part of that weakness.
That's the demand side. Then there's also the supply side, the idea that OPEC Plus has maintained certain output cuts and that shale producers in the United States are actually producing almost a fifth less oil than they were, say, a year ago or, ahead of the pandemic. How high do oil prices get before all of that supply starts flooding online?
I think that's the million-dollar question right now. I think you're exactly right. Supply has been a very critical factor, and I think full marks to OPEC for how they've handled the market. This is very much their achievement, and they will take a lot of credit for this. Saudi Arabia, in particular, coming in with that 1 million barrels per day of voluntary cuts. They will start bringing that back from April onwards. But to your point, shale production, we don't think is going to go back to the 2019, the pre-COVID levels anytime soon, if ever, because they are more focused on discipline or like shareholder returns right now. I think in terms of oil prices, part of the problem is that the market can see this rebound in demand coming and supplies remaining tight, exactly what we're talking about right now. But we aren't really going to see the actual demand recovery till Q2, potentially even the second half of the year. But this is a futures market. We always discount stuff that's going to happen in the future now. That's why prices are rallying right now. Should prices today be $60? No, but we're trading April futures. And yes, things will sequentially get better. Remember, we've also got a very, very easy monetary policy, so much liquidity in the system. We've always called for $80 plus oil in 2022. Maybe that is $100 now, given how much liquidity there is in the system. I wouldn't rule that out.
We've been talking, Amrita, this whole program about how people are doubling down on this reflation trade, the recovery trade. And you do have some naysayers, David Rosenberg among them, and also Mike Muller of VTOL, of the Asian operations. And he said over the weekend, the market is getting ahead of itself when it talks about oil prices going much higher from here. Do you agree?
I do think if you look at prompt fundamentals, yes, the market has gotten ahead of itself because right now demand is still relatively weak. It is going to get better. But again, this is a reflation trade. People are not going to wait for the event to happen to position. Why not position now if airlines will reopen, whenever that is? If not Q2, it will be Q3 or Q4. And I think that is part of the problem. You've seen this across asset classes, right? That the reflation trade, to your point, is very much in vogue. However, above $60, there will be headwinds from supply. Yes, U.S. production may not go back to 2019 levels, but it will start to rise. OPEC compliance might start to slip a little bit as well. So yes, I don't think this is going to be a straight line higher. We are also very cautious around the prompt. There's still a lot of unsold barrels in West Africa, for instance. Yeah. But it doesn't take away from the fact that the second half of the year does look much, much healthier in terms of demand.
Set the scene. $80 to $100 crude next year, second year of the Biden presidency. Tom Keene, it was Neil Dutter of Renaissance Macro last week who I think nailed it. Park the politics. Get rid of the politics when you start to make market calls. Well, because if you made a market call based on the politics, you wouldn't be at 80 to 100 on crude.
I mean, Amrita, frame this out. There's a trading range 70 to 80. No one believes in that. And then as John mentions, there's a migration back to 100. No one believes in that. How likely is it?
Look, that's an outside chance. I don't think the 100 is a base case at all. For us, the base case has always been around $80 next year for the simple reason that A, demand is going to go back to pre-COVID levels. B, we've even got Iran coming back. We've just put out a note saying Iranian production will probably come back by more in the second half of the year. We've always been very clear on the timeline that it's not going to come back before June. But with the Biden presidency, or administration rather, engaging or likely to engage with Iran, volumes will start to come back. But then once Iran is back, there's very little spare capacity in the system. OPEC will continue to bring oil back to the market. But non-OPEC supplies, which nobody talks about, there's no investment. Everybody is going after net zero. Everybody wants to be in the green, or has to be guided by the green agenda. If there's no investment in the upstream, where is the marginal barrel of supply going to come from once OPEC has exhausted whatever it can bring on to meet the increase in demand? That's the question for next year.
And Rita, always great to catch up. Come back soon. And Rita Sen of Energy Aspects there on the crude market. $60 and about 20 cents on Brent. WTI at about $57.60-ish. Tom Keene, just on the CPFC function on the Bloomberg, just to get those forecasts quickly.
Oh, excuse me, please.
Year end on Brent, your median forecast is about 57.70. 57.70 for 21. So that's the story in the forecast, Tom, and where we're priced right now. It's not a market that's bulled up, at least on the south side, looking out to next year.
Should we invest in the demand elasticity on BitDog? I mean, look at it, John.
Do you want to go there?
Popping
You go there.
44,000.
Talk to me about Bitcoin.
John, 44,000. It won't go down.
Institutional buying, I think, is absolutely vital. We've talked about that, Tom, in the last 30 minutes.
Are we going to get tick by tick, Tom? Is that what we're going to get?
It's
44.
Like
it's down to 43.
We should be on it. Every tick, 44,
John, are we going to get up to
45?
80?
We're up 17%.
Are we on 80 watch?
Who upset you this morning?
Get Scott Minerd on the phone.
Who upset Lisa this morning?
It's the hand, you know. It got camouflaged over right to my
Monday.
head.
You've got a busy week ahead of you.
I'm blinded by the lights.
Here we go.
Sing.
You had a drink last night.
It's beautiful.
Yeah.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
looking bullish this Monday morning. Good morning to you all. Biggest weekly gain going all the way back to early November on the S&P 500. 5-day winning streak could become 6. The S&P 500 up 0.4%. The Nasdaq also up 0.4%. All-time highs on the board this Monday morning. Switch up the board. The story for me, not on the equity market. We've all got used to all-time highs after all-time highs. The real story's in the bond market, isn't it? Yields up on a 10-year, 119.81. That is your new post-pandemic high on a 10-year Treasury yield. Right now, just off it at 118.77. The interesting part about today's session, the bond market coming along for the ride as well. Yields up 2 basis points there. Negative 42 still on a 10-year. Let's not lose sight of that. The appetite for higher yields is there in this market. Inflation expectations, market-based inflation expectations, getting back out to 2014 levels. It's looking toppy. Maybe for good reason. The package down in DC is huge, and that's where the debate is politically right now as well. This one, though, switch up the board, could become the political hot potato. Companies now actually actively taking cash reserves, Tom Keene, and thinking about diversifying them into Bitcoin. Tesla, Elon Musk, thinking about and doing just that. Bitcoin this morning up by 16.67%. Tom, the bull case is simple. Institutional buy-in.
Yes.
Volatility rolls over. You get a little bit more transactions there. A little bit more buy-in once again for Bitcoin. The bear case, Tom, you know it well. It is very, very simple. It won't take a lot to crash this.
But John, very important. I think, John, we got to stay on this. It's so important. That bear case is when do the governments blink? I mean,
I think that's the story, Tom. I think you nailed it. You and I were talking about it in the commercial break. One press release. That's all it'll take.
Yeah.
One government, one press release. This changes course.
On Bloomberg Radio this morning, Bob up in Deluxebury, Massachusetts, getting off the Tom Brady win. He says, Tom, I told you to buy Bitcoin at 4,000, which is unfortunately true. Let's go to Serious Economic Matters. Ethan Harris with Bank of America running all of their economic research. Ethan, I like how you and Michelle Meyer do the math. 4% of GDP plus 9% of GDP is a Larry Summers impulse of 13% of GDP. Is that too much?
Well, it's unprecedented. I mean, if you take the two packages together, the one passed in December and the one on the table now, it's as big as what we did last spring when the economy was in free fall, when the unemployment rate was 14.3%. Now the unemployment rate's only 6.3%. Just these two packages, not including all the stuff they did last year, just these two packages are much more than double what the U.S. did in the 2009 recession. So I've described this as clients as it's like the big gulp at 7-Eleven, you know, that 30-ounce bucket.
I wouldn't know about that.
Soda. Well, this is like drinking two of those.
Okay, well, Ethan, you know, on the big gulp, I look at the other debate, which is an open and closed economy, and that some of the economic templates of the past are much more closed economies that are not international. How does that fiscal stimulus affect America if we are much more an open economy now?
Well, I mean, when you put that kind of demand stimulus into the economy, and by the way, it's not going to show up right away. It's going to show up when we reopen the service sector and all the money that people have been holding in their bank accounts goes out into spending. But yeah, I mean, a lot of it's going to leak overseas in terms of stronger trade. It's going to provide a modest boost to global growth. But, you know, we still are a relatively closed economy. It's going to be very service-focused spending, all the stuff that we've been unable to buy for a year now. That will boom, and that's mainly domestic spending. So it's going to spill over, but most of it's going to stay at home.
Ethan, how much is 2009 a correct comparison that we should be looking at, both in terms of the nature of the shock as well as how quickly the economy accelerated afterwards? In other words, a lot of people said we didn't move quickly enough, and that's why the recovery took so long. This time, we want to fix that mistake. What's your take?
Well, I think that it's correct that there wasn't enough fiscal stimulus in 2009, and we knew it at the time. We knew that 6% of GDP stimulus was inadequate given how massive the recession was. And the other thing we knew is that they gave up too early. They stopped doing additional fiscal stimulus when the unemployment rate was still over 9%, and there was no follow through at all. But I think people are looking back at that and not taking the lesson right. We're not waiting. We're not sitting here at 9% unemployment. We're down to 6.3, and we haven't even felt the effects of the latest package. So this is a very strong reaction to what was a policy mistake back in 2009. The other thing I would point out is in 2009, one reason you had such a crummy recovery was because you had a banking and real estate crisis. And we know that those crises always produce weak recoveries. There's a lot of economic historians have written about this. This is different. We don't have a banking real estate crisis. We have a healthy banking and real estate sector. So once the economy gets going, you're going to have a more normal recovery with or without the stimulus. So the 2009 analogy sounds great as a talking point, but when you look at the details of it, it's hard to justify, it seems like an overreaction to that historic experience.
So are you saying, Ethan, that you think that the high asset prices that the Fed is allowing to continue actually help them achieve their goal of lower employment and higher inflation?
Well, I mean, you've got both the Fed and fiscal authorities with their pedal to the metal. It's like you've got two accelerators and no brake. So that's going to be very stimulus to capital markets. I think the danger here is not in the immediate future, but more, at what point do we kind of say, okay, now we need to apply some braking here. We're starting to get a little bit of inflation in the system. How do the markets adapt?
Yeah.
If the Fed starts hiking. I think it makes more sense to go slower, I think.
Ethan, over the last year, there's been a huge conversation about...
Okay, ladies and gentlemen, as you can see, we closed position on Euro at 120.26.5. Okay, well done, all of you guys who follow this trade. We made a trade in how long? We started, let's say, 1 o'clock. We sold short and we closed position in half an hour with profit. Okay, speak to you later, guys. Check our webinar that will be held on Wednesday at 2300 hours. And if you want to join, if you want to get a strategy, please join. Otherwise, you can keep following the trades, yeah, and see how we make profit.
Performance at the low end without overheating the economy. I don't think you address inequality by creating a huge boom that eventually creates inflation. I think that that's not a lasting solution. The solution has to be education and redistributive tax policies. And we all can agree or disagree on that from a political point of view. But those are the tools for the task, not massive monetary and fiscal stimulus.
So, Ethan, from your perspective, then, it sounds like that you would be in the camp of Larry Summers on the composition of this program that's been put together down in D.C.
Yeah, I agree that they're pushing a little too hard here. I think that I'd love to see what the economy looks like 2 quarters from now when we're reopened and people have been vaccinated, service sector's coming back. And then you can figure out whether you've really done enough or not. It doesn't mean we don't need any fiscal stimulus. We need to address the most hurt parts of the economy. But giving stimulus dollars to people who are doing well only goes into bank accounts and comes out the other end when the economy recovers.
What is your GDP call 12 months forward? I've really lost sight of it, Ethan. It's become such a blur.
Right. So we've got growth this year of 6%. The Bloomberg consensus is 4.1 right now. So we think consensus has got a lot of catching up to do. And then we've got 4.5% growth next year. But that's based on our assumption that only half of the 1.9 trillion would actually be enacted. If the whole thing gets enacted, we're going to have to revisit those numbers. And by the way, that's the fastest growth since 1984, coming out of that massive 1982 recession. So we've got a very strong growth coming out of this recession.
Ethan, wonderful to catch up. Stay close. Ethan Harris there. of Bank of America. Thank you, sir. Your equity market, all-time highs at 14 points on the S&P 500. That debate, Tom, on wealth inequality is massive because this is the one part where I think the Federal Reserve is almost working against the Treasury here, just a little bit. And I'm not talking on a net basis. I'm just talking about this very, very unique situation. If you boost asset prices, one of the consequences of that, the outcomes, the haves have more, the have-nots do not. That is very intuitive, which is why Olivier Blanchard, formerly of the IMF, is making the argument that if you want to...
I'm placing a stop on profit for Canadian dollar. So all of you guys who purchased short position a few hours ago, it's time to place a stop at 127.73.
February of last year, it approaches 12 million bodies. Those 12 million bodies, John, will help get that inequality back on track.
Professor Blanchard won the argument in the last cycle, Tom. And many people, including Janet Yellen, former Chair Janet Yellen, now Secretary Janet Yellen, were conditioned by that experience too, Tom. And that's going to be the test case. That will be the ultimate case study in practice. They are looking to do this over the next several years.
Well, we'll have to see again on the inequality, but to me, it's just get over what we've heard really from March of this year. We got to get through the pandemic, and as Ethan Harris says in his research note, you know, we're making headway on the vaccine. It just takes time. All the conversations this morning, John, are simple on radio and TV. June. I mean, it's not March. It's
not March.
June.
It's June and maybe a little bit later.
Yeah, whenever.
In other places.
But it's June.
In Europe, it ain't June. Let's be clear about that. It is not June.
I think people are, yes, I think people are in strong agreement with you on that.
From New York City.
By the way, I was going to defend the Fed.
Were you? Wow.
Yeah.
What? Okay. Do we have more time?
Okay, I was just going to say.
I was just about
really
to,
quickly.
Wow. Okay.
They're struggling because higher asset prices has been their stated goal. How do they move away with that from that without affecting income inequality?
I was going to go, but you know, I run the clock. So do you want some more time?
No,
Are you sure?
Yeah.
You want to defend the Fed?
I wanted to defend the weekend.
Do you want to defend the Fed? I wish someone had, why didn't you tell me?
Well,
I'd give you all the time in the world.
I mean, I could have tapped you on the shoulder. Next time I'll tap you on the shoulder.
Coming out.
I'll throw him,
I'll run to the other studio.
Straw.
I'll catch up with Matt Hornback and Morgan Stanley on this bond market.
Oh, you're leaving us? I'm shocked.
Jill Carey Hall of Bank of America on this record high equity market. I might bring Lisa with me.
John, by the time you go live, we may have Bitcoin 50,000.
I'm sorry, Lisa, sincerely. I had no idea.
It's fine.
Usually when you've got something to say, you get really agitated, but I guess you weren't angry.
John, next hour, where's Givenchy?
Where's Givenchy in the next hour?
Yeah, next hour.
God. The wealth inequality around this set. I do not wear Givenchy, Tom. You
Neither
might.
do I. No,
yeah,
I don't
right.
wear Givenchy.
Okay. Futures up 15 on the S&P. Record highs. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Treasury Secretary Janet Yellen is making her case for Congress to pass the Biden coronavirus stimulus plan. Yellen says the U.S. can return to full employment next year if the package is enacted. Without the stimulus, Yellen says it may take until 2025. Republicans argue that the plan is just too expensive. Donald Trump's second impeachment trial is almost certain to end in acquittal. Still, it will deliver a public reckoning for his presidency, and it will influence whether his populist supporters continue to dominate the Republican Party. The impeachment trial begins tomorrow in the Senate. In London, Brent oil rose above $60 a barrel for the first time in more than a year. It's another milestone in a remarkable comeback from the biggest demand destruction in a generation. The coronavirus pandemic led to lockdowns and grounded planes. And in sports, Tom Brady is still super. The 43-year-old quarterback guided his new team, the Tampa Bay Buccaneers, to a 31-9 win over the Kansas City Chiefs in the Super Bowl. It was Brady's record 7th Super Bowl win. The other 6 were with the New England Patriots. He threw 3 touchdowns and was named the game's most valuable player. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Do you have any interest if President Biden invited you just to come and take a tour of the White House just to see what it looks like?
If he wants to talk about how to empower people, boy, I would be there in a nanosecond.
Trading revenues coming in better than expected. Everything cash, $1.1 trillion of cash. One of the most notable aspects of this report that was stellar.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we maybe help people out more.
We have an enormous number of big ideas. You need to have a business model fundamentally where when you do well, the world around you is doing well. If that is broken, it's very hard to fix.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
I'm afraid that the job market is stalling. We saw that in Friday's employment report. We're in a deep hole with respect to the job market and a long way to dig out.
Secretary Yellen in conversation there with Margaret Brennan, Face the Nation, on where we're going with the job market, where we're going with stimulus, and what it means as a stimulus of the market. Right now, what you need to know is Bitcoin really setting a bid at the 44,000 level. I'm not predicting higher, but I can tell you that after the pullback almost to 45,000, we've got a nice bid here, a very nice technical construction at the 44 level. Elon Musk and Tesla will take the doubloon for the purchase of Tesla, and that lifts Bitcoin this morning. We spoke with Howard Ward earlier this morning on his enthusiasm for having the courage to be in the markets. Like Howard Ward, Gina Martin-Adams has had that enthusiasm. She resets this morning as well. Reset now, Gina, versus the courage of December of last year. We're all of what, 7 weeks in, 8 weeks in. We've got to reframe our courage. How do you do that?
Yeah, it's an interesting comparison, because if you think about last year, in particular in December, we were coming off of the election. We were coming off of sort of a rotation into value and small cap stocks. There was still a tremendous amount of skepticism that earnings would grow at the pace expected into 2021. And what we've had, the big reset for me so far this year, is the earnings season, which, I mean, frankly, is just blowing away expectations. Companies are on much sounder footing than anyone thought. And that, to me, is what's continuing to power this market higher.
Where on the income statement is that blowing away expectations? My guess is it's not revenue, but down. Is it cost of goods sold? Is it the gross margins are holding up? Or do you go deeper into the financial part of the income statement?
It's actually across the board. You'd be surprised, but revenue in the fourth quarter posted a pace of growth faster than 5-year average.
I did not know that.
When you exclude the energy sector. Yeah, so it's quite unbelievable, frankly, to how fast companies migrated to the stay-at-home environment and have been able to leverage very, very low-cost wages in particular to produce earnings growth. But even on the top line, expectations were far too low. Across the board, analysts were expecting a decline in sales year over year. They were expecting a decline in EPS year over year. In the end, when you exclude the energy sector, which is 2% of market cap of the index, but is dragging a lot of the fundamentals lower, you exclude that energy sector, the index is on pace to post nearly 5% revenue growth year over year. Your 5-year average revenue growth, excluding the energy, analysts were expecting a near 10% decline at the start of season. In the fourth quarter, the S&P 500 constituents posted, we think, closer to 4% growth in EPS year over year. So it's across the board. They're just beating expectations. And importantly, starting to guide for much better growth into 2021 as well.
Are there parts of the market that are being left behind when it comes to corporate earnings? I mean, I'm thinking about how we haven't reopened. We've been talking about the transatlantic corridor and how international travel isn't taking off. Cruise liners still aren't making any money. I mean, how are we looking at these sectors that people are betting on in hope, given that the reality right now doesn't seem to be there?
Yeah, I think that energy is a perfect example of that, Lisa. It's a one sector that is continuing to post double-digit declines in EPS, double-digit declines in sales, will probably continue to post declines throughout at least the first half of 2021. You've got the same story going on with airlines, some of the restaurants, certainly some of the more economically sensitive entities within the index are struggling. The interesting thing about the S&P 500, of course, is it is the biggest of the big cap companies. So a lot of that weakness over time starts to diminish, right? The companies naturally fall out of the index or they become smaller in market cap, so they're not as big a drag on the fundamentals. So we do tend to get a skew to the positive just because of constituent bias in the index. Nonetheless, there are still pockets of weakness. They're just being overwhelmed by much stronger growth than expected. You know, 5 of 11 sectors posted much faster EPS growth than expected and actually posted positive growth relative to the expectation for a decline. So I'd say the breadth story is still about much more positivity than anticipated, though there are certainly pockets of weakness to acknowledge.
Gina, this is so important. I mean, when you talk about the index level, certainly it's being carried by some of the biggest names. Are you saying, though, that perhaps the cyclical trade, this trade into hope for the future rather than actual on-the-ground earnings or forecasts from the CEOs of those companies, perhaps has gotten a little ahead of itself because the behemoths and the winners will continue winning?
I think when it comes, it's a case-by-case basis. I wouldn't paint it with one big brush, right? But I do think in the case of energy, the reason that investors are piling into energy is chasing returns, for one. The price momentum has improved remarkably since October, November, but also in anticipation of inflation pressures.
Okay, ladies and gentlemen, we closed position on Canadian dollar at 127.73. So all of you who followed our trades made a profit on this trade too. Well done.
The index were extremely low, so there was room for improvement in price performance for some of these names, but at some point you do need to have the fundamentals back. So I think on a case-by-case basis, you want to be really careful about playing this idea of a broad-based inflation surge, and some investors are hiding in inflation-sensitive segments that don't have a ton of fundamental support, frankly.
Gina, got to leave it there. Gina Martin Adams, not enough time. Thank you. We'll do it again this week. Gina Martin Adams, Bloomberg Intelligence with perspective on a market. She's had the courage to stay in. Futures up 15, Dow futures up 139. Lisa, what's your Monday observation?
Well, I mean, honestly, I have to watch Bitcoin and the idea of whether it can actually be used as a currency. And I know I'm going to get hammered for this, but this idea that you were talking about with John, about how the government could stop this rally if they just came out and they gave some sort of regulatory sign that they're looking at cracking down on Bitcoin. They don't seem to be willing to do that, especially because there is also a populist tilt behind Bitcoin. Let us do our own thing. Let us have our own crypto gold. And frankly, it has been quite clear that there is not the political will to go against that in Washington, D.C.
Okay, well, you know, I'm not saying the currency debate is so important. I'm saying the debate, as Ken Rogoff lays out in The Curse of Cash, about what's it being used for and how do we monitor the flows. We came out of an ugly day in September of 2001, and decided we needed to get a lot smarter about flows.
It's a really important point, and how much visibility can we get in? There's another point too about the froth indicator that a lot of people view Bitcoin as, this idea that people are bidding it up because they believe in their inflation trade, they believe that the dollar will be less valuable going forward, and you do just wonder how far that's going to go before it gets checked by something, perhaps on the ground, Tom.
We'll see as we get closer to the opening. The VIX 21.55. The VIX really hasn't come in. There were a couple good charts over the weekend of where the VIX is. You know, you look at the futures curve of the VIX where it should be, which is a couple big figures lower and more complacent. It's been a really interesting Monday, setting us up for a week. And again, in Washington, we'll look to stimulus debate. William Daley of Chicago, Wells Fargo Vice Chairman, Balance of Power today. Bill Daley will have a few bits of perspective on the outcome of stimulus. Please stay with us on Bloomberg Radio, on Bloomberg Television. Good morning.
Focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops, infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it, stay on schedule if it's a bus, or avoid other vehicles, avoid accidents, provide information about weather conditions, potential hazards down the road, and so forth.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes to go. Equities at all-time highs, and we add some weight to it, up 15 points on the S&P. We begin with the big issue. A big fiscal package is on the way.
It appears that we're going to go to the bigger plan.
A big fiscal support.
Significant fiscal policy.
I think we're looking at 1.7 trillion.
There's a political statement about you can't go too big.
That's really the focus here.
Some people are worried about the additional stimulus maybe triggering a much hotter economy.
We do have inflationary pressures building.
We have to be ready for inflation to actually run over the Fed's target.
The risk here is that you've got both accelerators pressed too hard.
Monetary policy and much more on the fiscal policy.
And you get more financial bubbles and you get an inflationary scare.
It's going to drive real rates up.
You're starting to sense that in the bond market.
We're in danger of those markets overheating.
This fiscal stimulus is going to be big.
But is it too big? Former Treasury Secretary Larry Summers making waves writing the following. There is a chance that macroeconomic stimulus on a scale closer to World War II levels than normal recession levels will set off inflationary pressures of a kind we have not seen in a generation. Those comments prompting a swift slapdown from President Biden's Council of Economic Advisors.
Again, with respect to Larry and his piece, it's just flat out wrong that our team is, quote, dismissive of inflationary risks. Janet Yellen is our Treasury Secretary, okay? She knows a little something about inflationary risks and has tracked that kind of, has tracked that economic issue forever.
We have a Treasury Secretary. Her name is Janet Yellen, and Secretary Yellen had her own response.
My predecessor, has indicated that there's a chance that this will cause inflation to rise, and that's also a risk that we have to consider. I've spent many years studying inflation and worrying about inflation, and I can tell you we have the tools to deal with that risk if it materializes.
Let's bring in the Bloomberg team. Kevin Cirilli down in D.C. and Bloomberg's Michael McKee. Mike, let's go to you first. It's not just the size. The pushback here is on the composition.
Well, there's been a lot of talk about this on Twitter and places like that, of course, and what the Twitter universe seems to have missed is that the administration is not arguing with Larry Summers' point. The point is that inflation could, not definitely, but could rise faster than forecast. For one thing, the output gap is about 3 times smaller than the stimulus package is measured by the CBO, and 5 times the size of the shortfall in family incomes at a time when unemployment's falling, pent-up demand may be released if the virus gets under control, rates are at 0, and we have booming markets, as you heard there, and a weak dollar. Now, markets have figured this out. Inflation break-evens have been rising steadily for the last couple of months, basically since we saw the vaccines approved. We also know inflation is going to pick up statistically. Not this week. We get CPI on Wednesday. It's going to be a slight tick up, but just wait until March, April, and May when the big COVID drops from last year's economic shutdown fall out of the data. The Fed will look through that. Of course, they've been telling us they're going to look through that and warning investors not to overreact because it will go away. But what if it doesn't? That's the question for the reasons I outlined. Then we get to the heart of Summers' argument. Can a Fed that now by policy says it's going to react slowly to inflation successfully manage the market's reaction? They struggled during the taper tantrum when Ben Bernanke just mused about the idea of maybe tapering back some QE. Jared Bernstein is right, of course. They have thought about this, and Janet Yellen's right. The tools do exist to deal with inflation, but can they and will they let us help them in time? That's the question the markets must debate.
Let's bring in Kevin Cirilli down in D.C. This is a political hot potato at the moment, Kevin. What's the messaging coming out of the administration?
Democrats are saying that they are on path to pass the stimulus proposal, if not within the next 2 weeks, by bullish estimates, sometime within the next 3 to 6 weeks. In terms of the tension that really kind of bubbled over on Friday in the Brady briefing room with Jared Bernstein, I spoke with him after that briefing, Jonathan, later that afternoon, and he again doubled down to what Michael McKee was just reporting and suggesting that they believe that they do not have a choice but to continue with a $1.9 trillion stimulus stimulus proposal. Now, he also pointed to people like Senator Mitt Romney, a Republican from Utah, who have extended a political olive branch of sorts in saying that there are some moderate Republicans who are willing behind the scenes to work on some back channel negotiations. We should note, of course, that the process vote that took place last week in the Senate fell upon party lines. Jonathan?
Kevin Cerulli down in D.C. It is the debate of the moment in economics down in Washington. Mike, thank you to Kevin as well. Let's bring in Morgan Stanley's Matt Horn back on this issue. Matt, great to catch up with you, sir. Is 1.9 trillion with this composition too big?
Well, thanks, John, for having me back on. I mean, whether or not it's too big, I mean, the question I ask myself day to day is, are markets pricing it in? And our perspective is that the markets may be pricing in the deficit impact on U.S. Treasuries from a supply perspective, but we don't think that markets are yet pricing in a $1.9 trillion package, either from a growth or inflation perspective. And I think this debate you are hearing between Janet Yellen and Larry Summers sums up why markets have a tough time pricing in these expected growth and inflation impacts, because there are debates that surface in the markets around them. Whereas when you're talking about Treasury supply, you have a much better idea whether or not the Treasury will have to issue additional bonds or not. And we don't think that they are going to have to issue those additional bonds in the coming months to finance a $1.9 trillion stimulus bill.
Matt, you say it's not priced in. 30-year yields were through 2% this morning. I know historically that's not much at all, but break-evens are breaking out again. Market-based inflation expectations are out to 2014 levels. What aren't we pricing in specifically?
Well, John, I think there's a couple of things. Number one, on the growth side, yes, real yields have stopped falling. That's a start, but they haven't really begun to trend higher yet. And so that's one thing that we would look to see happen in the wake of the passage of a stimulus bill the size of which we're talking about, 1.9 trillion. You'd expect real interest rates to start to move higher. We haven't yet seen that. Number two, on the inflation side, you're right, John, break-even inflation rates have increased, but when we look at the decomposition of them, we have hardly seen any movement in inflation expectations. We think that at the end of the day, you are going to have to see inflation expectations begin to rise, and that is going to require some upside in realized inflation. We haven't yet seen that, John. We think that's coming. We think we'll get there, but that just means to us, markets aren't yet pricing it in.
So, Matt, let's add to that. So we've got some supply chain issues we can identify in the global economy right now. We know there is a big inventory build underway in certain parts of the global economy too. That is naturally going to lead to an inflection point for PPI prices, a tick higher there, Matt. I imagine that's what you anticipate too. Can you walk me through how we get from there to sustainably higher CPI prices through into 22?
Well, John, if you want to talk about sustainability, you have to start with monetary policy. Will the current setting of monetary policy be sustained through the course of this year? We think the answer is yes. We obviously don't have the Fed hiking rates this year. We don't think the Fed is going to start tapering their bond purchases this year. So we are expecting the sustainability of monetary policy to be there to support inflation moving higher. That's one. And of course, number two, John, when you're talking about the currency impact, we don't necessarily think the dollar's got a lot of strength to show here. We don't see a tremendous amount of downside remaining for the dollar, but the dollar has weakened year on year.
Yeah.
That should also help inflation, John.
Given where growth differentials are, though, Matt, and where they're heading, particularly between Europe and the United States, why would you push back against that view?
Well, I mean, we're not pushing back against the idea that the dollar should be perhaps marginally weaker on global growth. But here's the issue, is that because these growth differentials are going to be favoring the U.S. going forward, we see that as counteracting the broader global growth story, that broader liquidity story we've talked so much about in our research.
Yeah.
We see that both of these factors pushing back against each other, keeping the dollar broadly stable.
Chairman Powell Wednesday, Matt, what are you looking for?
Well, more of the same. We don't see any reason for Powell to change the narrative at this point. They're going to stay the course on monetary policy. Of course, they 6 months ago unveiled their new monetary policy strategy. They're going to stay the course on monetary policy, and I would expect more of the same from Powell, as we heard going into the January FOMC meeting. Stay the course.
Matt Hornback, staying the course over at Morgan Stanley. Matt, always great to catch up. Stay closer. Let's get to the market desk and get you some movers. An equity market at all-time highs with your movers. Here's Abby.
Good morning to you, John. And yes, the S&P 500 set to open at another new all-time high, up for a 6th day in a row. Let's start out with one of the big stock stories. Tesla popping higher, up more than 2%. This on the news that the company is accepting or has invested $1.5 billion in Bitcoin after altering their investment policy about a month ago to accept to be able to invest in digital currencies along with gold and gold-backed ETFs. They've also signaled that they may accept Bitcoin and digital currencies as a form of payment. On this, we have some of the blockchain related and digital currency related companies such as Riot Blockchain and Marathon Patent Group popping, soaring sharply higher, a bit of a mania there. Now, rounding out this report, John, to the reflation trade, not going completely off the rails here. Take a look at big energy, up sharply, up more than 2%. This as oil continues to rally as demand is strong, supply constrained. Brent crude, as you know, back above $60 per barrel. And then the banks, one of last week's big winners along with energy, up once again in the pre-market, climbing on those inflation expectations.
Abby, thank you. I think the Bitcoin story is important. I think it's really intuitive. The more institutional buying we get from corporations who want to manage their cash in a particular way, the more institutional buying we get, the lower the volatility we might get in the future. That will lead to bolstering the end use case for Bitcoin as well, and will ultimately lead to more institutional buy-in. And then it gets more difficult to undo for the governments that do want to step in. So the bulls this morning have got some fuel for their theory. Coming up on the program, the sell-off in treasuries pushing 30-year yields above 2% for the first time in a year. That conversation up next with Academy's Peter Cheer from New York City this morning. Good morning. Stocks higher. 5 days of gains last week. Can we make it 6 this Monday morning? Up 0.4%. This is Bloomberg.
feel they have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Yields are moving higher for the right reasons, which is growth rather than policy tightening. It shouldn't be too strong a headwind, at least not yet. There will be, a fair amount of tolerance of this, but particularly if the Fed, remains easy and wants to be behind it.
It's the story of the morning, the story of the last couple of weeks, higher Treasury yields. UBS's Stuart Kaiser expecting rising bond yields to have little impact on the equity rally as reflation bets continue ramping higher. Joining us now is Bloomberg's Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, certainly not affecting the equity rally this morning. That continues to roll on. S&P E-mini futures up around 16 points right now, though it is the cyclically sensitive small caps that look set to outperform at the opening bell. But as you alluded to, those reflation growth expectations are reflected more in other asset classes. You are seeing yields moving off their earlier highs. The 30-year yield did break above 2% for the first time in about a year earlier. It's now sitting around 1.9%, but nonetheless, that, of course, a very important psychological level. And then when it comes to oil, Brent crude above $60 a barrel for the first time since last January. WTI up around $57 a barrel at the moment. And of course, those high oil prices are at least partially to blame for higher break-even rates, John. Inflationary expectations more broadly also a factor, but today the U.S. 10-year TIPS break-even hit the highest since 2014, right now sitting just above 2.2%. That is higher than every yield in the Treasury market, John. And finally, all of this inevitably ties into the FX market as well. A weaker dollar would, of course, aid inflation because if you can't buy as much with the dollar, that means prices are going to go higher. And of course, the dollar is off its most recent lows. In part, that's due to the tie between currency performance and the vaccine rollout. But the expectation is that dollar weakness is going to continue moving forward throughout the year. You can see that at positioning here on GTV Go, just how bearish leverage funds are. Speculators net short the dollar with a net short position of about 235,000 contracts, John.
Kaylee Lyons, thank you. A lot to get through here. The dollar story, higher yields, higher inflation expectations. Academy's Peter Chin not expecting any signs of policy tightening until inflation averages at least 3% for 6 months, if not longer. He writes the following: the long bond has rarely been above 3% since the global financial crisis, and the Fed, as well as the Treasury, will be reluctant to see it cross that threshold, as who knows what it would do to the economy or to markets. Peter joins us now for more. So, Pete, there's two things we've got to do here. Work out what it means for the economy and work out what it does for the market. Can we just sit on the last point, the latter? What it would do to markets? 2%, 2.5%. When does it start to bite, Pete?
I think it starts to bite on the 10-year as you get above 1.5% into 175. So I think the Fed is going to work very carefully to ensure that as we get to that yield, which I do think we're going to get, it's a slow and gradual pace to get there, in which case we have time to absorb it from the market's perspective.
Can we talk about inflation a little bit as well? Someone wrote in about 10 minutes ago, Pete, and asked a very simple question, and I think dead on. We're seeing inflation expectations tick higher. We're not seeing it confirmed in things like gold. Why not, Pete?
I think gold has kind of moved into this separate battle with Bitcoin. Away from that, you're seeing it feels a little bit that it's transitory. And also, the reality is inflation expectations rarely actually turn into actual inflation. So I think the jury is still out on whether we're really going to get sustained inflation or not.
I think that's the most important market question right now, Pete, that the outlook already, the inflationary outlook has already started to pick up. So we're out to these levels we haven't seen since 2014. And for a market participant, the question, I think the relevant one is, where does the source of upside surprise come from on this front? And Pete, where does it come from?
You know, I think we are going to see real stimulus. We get that stimulus, we get infrastructure spending. That's going to create enough growth that we can absorb those higher interest rates. And we also have to remember that the Fed learned a lot of lessons. This is not going to be the Fed that caused a taper tantrum like they did. They are going to do everything they can to allow inflation to run hot and keep yields low. They are very conscious of what it does for markets. So I think you can actually be bullish and believe in inflation at the same time.
Behavioral biases, Pete. Be bullish, believe in inflation. High yields are a good thing. Lower yields are a good thing. Pete, high yields are a good thing. Lower yields are a good thing. That's the approach right now. Why?
Well, partly, too, I think we're seeing a little bit of rotation where you really are seeing anything that will benefit from infrastructure spending, a full reopening, really outperform. I know we're at all-time highs on the NASDAQ, but you're seeing these other sectors do very well. A lot of the big cap energy stocks are up 2% this morning already. So I think that's where the real growth and upside is for the next few weeks in the market, is pricing in infrastructure spending, reopening, and absorbing what higher yields mean. And those companies are probably less impacted than some of the big growth stories, which you're discounting cash flows from a much distant future.
Are you anchoring yourself to those themes right now, Pete?
Yes, I'm definitely the most bullish I've been in terms of those sectors. I've liked them for a while, and I'm really, basically all in those right now.
On the credit side?
Credit side as well. Anything that still has that COVID discount, I think, is worth owning, and anything that's going to participate in this infrastructure spending and build out is really worth owning, and you're going to get that improvement. I like the banks, and I want to kind of move down in credit curve. I want to own the triple Bs in the investment grade space. Those should outperform the most.
Do you have to dig around in high yield too?
High yield's interesting. Where I'm looking at in high yield is you want to pick some companies that might be interesting takeover candidates. The one thing that tends to happen in the credit markets is, these smaller high yield companies get bought out, and that tends to be very, very good for bondholders. So you almost want to play the M&A game in the high yield space.
In energy, is that a factor here too, Pete?
Yes, that's definitely a factor. Anything that's going to, where some companies have struggled, so they might be looking for a partner. You're looking for stocks that have rebounded. So again, the airlines, I think you can see a lot of value there. I think you're starting to see in some of the retailers that they've actually been able to shift to an online presence as well. So maybe there's some upside there. So really look for those beaten up areas. I think you're going to see continued improvement.
So Pete, this is a big call, because if you're in this market right now, and you've been in those positions for the last 6 to 9 months, you'd be looking at $60 Brent right now, $57 WTI, and you'd be asking yourself whether this is the position to exit. This is the moment to take the gains and walk away. Why is it the moment to add?
Because I think we are seeing a bit of a philosophy shift where people had been, say, betting against energy. And the reality is, yes, clean energy is going to be the wave of the future, but we still need real energy or traditional energy today. So I think people got underweight those. There was a little bit too much, hey, these are never coming back. So as tempted as I am to take profits, I'm actually adding, because I think that's going to be the momentum that plays out, that people realize, hey, we want to be clean energy, we want all these things, but in the meantime, there's a lot of potential for growth.
This is where I wanted to finish, Pete, and I brought this up a little bit earlier this morning. It was Neil Dutter of Renaissance Macro last week who basically just said, park the politics. Don't make market calls based on where you think political policy making is going down in Washington, D.C. Does your energy call speak to that?
No, I think I see politics as really going to be stimulus. We're going to get this Band-Aid round, then we're going to get proper infrastructure stimulus. So I guess I am actually betting on politics, but it's going to be the big picture politics of getting that infrastructure ahead of some of the details.
Pete, come back soon. I haven't heard you this bullish in quite a while, I've got to say. Peter Cheer from Academy Securities there. Thank you, sir. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. And then later around the opening bell, JP Morgan's Mislav Matejka will be joining us, weighing in on the rally in rate-sensitive sectors. And where have you found those sectors? You found them in the United States. Where have you found the number one sector? Belongs to the banks, the financials. Absolutely ripping last week off the back of high yields and a steeper curve. Is it sustainable? We'll get into that in just a moment. S&P 500 futures up 17 on the S&P. We advanced 0.4%, record high on the NASDAQ. All-time highs here on the cards, up 0.5%. And in Europe, coming along for the ride, the FTSE up 1%, the DAX advancing about 0.5%. From New York City this morning, 5 days of gains could become 6. Your opening bell is just around the corner. This is Bloomberg.
be an action that was either illegal or caused disruption. And this was really political satire, kind of writ large, and it was all about actually trying to get to the man himself and make him see how we see him. And in order to do that, we knew it had to be big and it had to be colourful and it had to be somewhere where everybody could see it. It's important because we didn't just do this for attention. This was actually about making a serious point, which is that the majority of people in this country do reject the politics that Donald Trump represents.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
You are looking at pictures of the President of the United States, Joe Biden, just getting into Marine One after arriving at Joint Base Andrews from Delaware. The President departing Air Force One and getting onto Marine One and heading back to Washington, D.C., back to the White House. No comments from the President of the United States this morning. That's the scene down in Washington. Time now for your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, JP Morgan upgrading Estee Lauder by 2 notches, raising shares to overweight from underweight. The analyst highlighting the company's digital initiatives and solid holiday sales. Your second call from Bank of America, downgrading Las Vegas Sands to neutral, a $57 price target. The analyst expecting a slower recovery in Asia to weigh on revenue in Macau casinos, up there by almost 5% going into the opening bell. Your third call comes from Stifel, upgrading Target to a buy with a $225 price target. The analyst cited the strength of the company's digital business and same-day services. We advanced just a little bit there by 0.14%. That's the story this morning from the south side. 3 of the calls for you. Up next on the programme, rising bond yields fueling a rally in the financials over the last week. JP Morgan, Bank of America, absolutely flying. That conversation around the corner with JP Morgan's Mislav Matejka. The inflationary story, higher yields, the rate-sensitive parts of this equity market. What do you want to anchor yourself to for the next several months? That's the story going into the opening bell. Equities higher, 5 days of gains set to become 6, up 0.4% on the S&P 500, 3,900 already in sight. It's February 8th. Remember the calls to 3,800, 3,850? 3-4 months ago, that was bullish. Looks a little bearish now, doesn't it? From New York, this is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Imagine it's the end of October, early November, you're putting your year ahead outlook together and you're thinking we'll have a gain of 18, 19% over the next 12 months. And then it happens in 3 and a bit. That's what's happened in this equity market. We're up 19% since the end of October. Unreal. Up 0.4% on futures going into the opening bell. That is your opening bell. Your outperformance is in the small caps. They have absolutely ripped going into year end and through the start of 2021. Switch up the board into the bond market. More recently, it's all about rates. It's all about the banks. We'll touch on that a little bit more a little bit later. Up a basis point on a 10-year. 119.81 is your new post-pandemic high. That print came this morning. 117.57 is where we sit right now. In the FX market, euro dollar just in and around 120 over the last couple of days, getting choppy. 120.46 unchanged right now. In the commodity market, 57 on crude, on WTI, on Brent. We've had a 60 handle this morning, up about 1% at the moment, cross asset. That's the story, cross asset. About 40 seconds in at the market desk with your movers. Here's Abby.
John, well, it's certainly a risk on. Tony, you were just talking about that unreal move for the S&P 500 right now heading toward its 6th up day in a row, the longest winning streak since August. But since October, that huge rally, also unreal. Tesla over the last year, as you know, up more than 750%. But over the last week or so, up about 10%. This, of course, today getting a nice boost as the company has said that it has invested about $1.5 billion in Bitcoin after revising their investment policy. And they've also signaled that they may accept Bitcoin and other digital currencies as a form of payment. Now, on this, we have various payment companies, and there we have Bitcoin itself absolutely soaring, a record high, up 15%. But Riot Blockchain, Marathon Patent Group, Square also all sharply higher, especially the blockchain and Bitcoin-related companies, as folks are seeing this as a sign of legitimacy. As for other movers on the day, we have GM getting a boost from Tesla. The stock is higher. They, of course, report later this week, but there is some hope that their electric vehicle push will be strong in terms of what they talk about, despite the fact that we have a shortage of chips. But chips is actually, that shortage is helping Applied Materials, the semi-cap equipment company. One bank raised their price target today around that. And then finally, Palantir Technologies partnering up with IBM, really helping IBM make their AI software easier for customers, while this will clearly expand Palantir's footprint, John.
Abigail, thank you. 2 minutes into the session, we advance 0.5%. That is a 6th day of gains on the cards on the S&P 500, all-time highs. Top of the pile, energy. Crude doing nicely. Energy stocks too, up by 1.7%. Middle of the pack, financials up 0.6%, driven by what we've seen in the Treasury market. Higher yields. At the back end, the 30-year through 2% briefly for the first time in about a year. Joining us now on the story is Bloomberg's Kelly Lights. Hey, Kaylee.
Hey, John. Well, it's that reflation trade roaring ahead. We've been talking about it all morning, and that is evident once again in the financials, which are outperforming the S&P 500 at the opening bell, and a number of them are higher in the first few minutes of trading. The likes of JP Morgan, Bank of America, Citigroup, and Wells Fargo all higher to the tune of about 1%. For Citi, this would be the 6th gain in a row. For the other three, they're heading for their 5th gain in the last 6 sessions, helped out, of course, by higher yields and that steeper yield curve. And this isn't just a story of today, John, really over the course of 2021 thus far. So just over a month, the yield on the 10-year Treasury note is higher by about 26 basis points, currently sitting right around 1.18%. And as that has moved higher, the banks have moved in tandem. The KBW Bank Index up more than 9% year to date. And the regional banks especially, who can't rely on trading like the big investment banks, are therefore more reliant on net interest income for revenue, have rallied by 13.4% since the start of the year. And it isn't just the banks, John. Insurance companies, of course, are tied to rates as well. The policies they sell their customers are market rate sensitive. They typically are heavily invested in bonds and other interest sensitive assets. So lower yields weigh on these companies as well. And at the pandemic low in March, the S&P Super Composite Insurance Index was down as much as 43%. But now, with yields moving higher, that index is sitting right around the highest since before the pandemic, going all the way back to 2020, February 2020. It's only down about 6% now from those levels, John.
Kelly Lyons, thank you. Jonathan Golliber, Credit Suisse, just publishing. I'll bring it to you very quickly. Rising Treasury yields are a positive for stocks. Mr. Golliber's had this argument for a long, long time, backed up by the data. While this might fly in the face of conventional wisdom, the explanation is quite straightforward. Improving economics pushes credit spreads lower more than they drive Treasury yields higher. Put differently, he goes on to say, improving economics lower the overall cost of capital. We'll catch up with John soon, I'm sure. I want to turn to JP Morgan's Mislav Matejka, wary of spiking interest rates for a different reason. There's an argument that rising yields and stronger US growth will drive the dollar up. If it were to show a notable strengthening this year, that would go against our bullish equity market call to a certain extent. Mislav joins us now for more. So Mislav, this is important, this distinction you're making. It's not about Treasury yields alone. It's the read across into the FX market. Build on it for us if you can.
Hi, I would say the first issue here is that the bond yields rising is positive for the equity markets, but if the dollar is rising as well, then some parts of equities, namely the emerging markets, will not be doing as well. And the angle here is 2013. You remember 2013, bond yields were up, but the dollar was up as well, and therefore the emerging markets did not participate.
And the stock market in the US was up, what, 28, 29, 30%, Mislav? Can't remember the price number, but it was there and thereabouts in the States. So what does that mean for US exposure?
So the stock market was up a lot in 2013, and therefore our overall view is very, very bullish still. Reflation, as you highlighted before on your program, is the key story. Rising bond yields are the confirmation that the economy is normalizing. Most clients I speak to are uncomfortable that bond yields can go up much, and they actually think if the bond yields go higher, that will be a problem because valuations are high and there is a lot of leverage. I disagree with that. In my view, rising bond yields will be a help for the whole of the positive trade. It is reassuring, and it is going to drive the leadership into financials, which is what was really missing the whole of the last year.
Mislav, do you think it could be a bigger problem, though, for the index, at the index level, just the mechanics of that tech weighting that has relied on lower yields to boost that valuation? Is it the index where there could be some risk away from, say, at the sector level in the financials?
For sure, technology was a big beneficiary last year. We had overweight technology all the way through up until the 2nd of November when it switched out of tech into financials. But I would make a big distinction here. This is not 2001 when technology was over its skis and had a crash and therefore the whole market went down. My view is technology still goes up in absolute terms. Yes, the bond yields are not going down anymore and therefore that doesn't help the valuations. And yes, the base effects on earnings are not as positive, but technology still looks quite good. The issue here is that it was a big winner, cyclical winner last year as well as structural. And as the bond yields go up and the rest of the economy rebounds, technology will go higher, I believe, just not lead anymore.
Just want to walk through the thinking just a little bit more. So higher yields increase the rate-sensitive part of the portfolio, the financials in the United States, the worry about the US dollar, maybe pare back some EM exposure. Mislav, can you take me into the US equity market and just give me a better understanding of where you would pare back exposure if a stronger dollar was the base case going forward?
If the dollar is somewhat stronger, then typically the emerging markets and to some extent the commodities are not your number one trade. So I had overweight, let's say, on miners all the way over the last 12 months. Last week we have cut miners again. There's nothing really wrong with them, but you have a bit stronger dollar, which is not great. And you have China credit impulse, which is peaking, which is an issue. So within the US equity market, you want to be with the domestic value, cyclical exposure, financials, consumer recovery, reopening trade, insurance as well, all of that. Bearish on the staples, real estate, utilities. And from my perspective, if the dollar remains resilient, then some of the direct EM and some of the commodities might not be really the best.
So pare down the miners. Mislav, where does energy fit in here? Because crude's flying. The energy sector's on top today. What's the energy call?
The energy in the US does not look too bad. US energy is really E&P driven and very tied to the oil price. If you look at, let's say, in Europe, energy sector is far the worst. It's one of the worst performing sectors this year. So there's a clear distinction here. In the US, energy is doing very well year to date. In Europe is a disaster. But what I would say that, yes, energy last year halved, and therefore it's bound to have some rebound. And the oil price, to your point, is beta play on the economic recovery. My view is if the China credit impulse has peaked, if the dollar is not really playing ball, at least from a European perspective, I don't have an overweight on energy. I'm not underweight anymore, so you can't be short after it has fallen so much as it did last year. But I think there are much better ways to express the reflationary trade, let's say in a European portfolio at least, and not just energy.
Mislav, enjoyed putting the puzzle together with you. Come back soon. Really enjoyed the conversation. Mislav Matejka there of JP Morgan. Thank you, sir. 10 minutes into the session, equities, record high. Become desensitized by saying that, but once again, I have to say, a record high on the S&P 500. The Nasdaq up by 0.5%. 6 days of gains on the S&P. At the market desk, here's Abby.
Risk on, John. It's pretty extraordinary because prior to those 6 days of gains, we actually had the S&P 500 down for the month of January and year to date. So lots of volatility. But what's driving these gains? The reopening and the reflation trade. So if we start out with the reopening side of it, we have both the cruise operators and the airlines sharply higher on expectations that at some point there is going to be more normal flow to travel. So you see Carnival and Norwegian higher off of the highs, or not so long ago, moments ago, up more than 1%. American Airlines up 1.5%. They're saying that their daily traffic rose 21% yesterday, even though that's down 65% year over year, moving in the right direction. And United Airlines going higher too. As for the reflationary part of the trade, of course, that has everything to do with energy, along with the financials. Two of the top sectors this morning. Look at Citigroup and Wells Fargo climbing higher as yields and the yield curve steepens. Chevron and Marathon both getting a nice bid as we have Brent crude above 60. We have WTI at 57. Hopes that the recovering economy is going to drive demand more, and there's a bit of a supply shortage, so that will certainly help oil. That could flow to the bottom line. And then finally, what's not working, John? Apple. We have tech in the middle of the pack sector-wise, but Apple's down. Yeah, down 1%. So folks are not seeking the safety of big tech on the morning, John.
It's the banks, it's energy. It's the story of the last week and maybe more. The story of the last several months, the small caps at another record high, mounting bets on a post-pandemic recovery, driving stocks to all-time highs. The reflation trade really kicking in over the last month. Weighing in, up next, Bank of America's Jill Carey-Hall from New York City this morning. It is a freezing morning in New York City. Tom Keene tells me this isn't cold. I don't know what cold is. I'm telling you, this is cold. This is cold. Come on. Equities at records. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Since May, we've been very positive on small caps, and we continue to be there. And what we think with large cap, things are fine, things are good. It's just we think there's going to be a rotation. We're beginning to see that rotation. And the way that the index is designed, you could see some of that rotation weigh on the index. And so we're just not as aggressive in the large cap space as we are in the small cap space.
Well, the small cap space is absolutely flying. That was Chris Harvey of Wells Fargo expecting small caps to outperform as the economic recovery gains steam. For more, let's get back to Kelly Lyons. Hey, Kelly.
Hey, John. Well, a fresh record high for the small cap Russell 2000 this morning. Thinking small continues to be the name of the game in 2021. Looking at it from a total return perspective, the S&P 500 has returned about 4% over the year thus far. The Russell 2000, on the other hand, think more 13%. And the Russell Microcap Index, which includes 1,000 of the smallest securities in the Russell 2000, has returned a whopping 23%. Granted, the stocks in that index make up less than 3% of the U.S. equity market, John, but still, that rally is remarkable. And this isn't just a weighting thing. The strength in the small caps has really been broad-based. When you look at the performance of sectors in the Russell 2000 on a year-to-date basis, not only is every single one of them higher, every single one of them is outperforming its equivalent S&P 500 sector on a year-to-date basis. Large cap energy stocks, for example, up about 12% over the year thus far. The small cap sector up a whopping 43%. For discretionary, it is 6.4% gain for the large caps, 19% for the small caps. You get the idea there. And of course, beyond the broad reflation narrative, there are fundamentals to factor into this. We are still in the middle of earnings season, and small caps fourth quarter reports have been surprising to the upside to a greater extent. The average sales surprise for a company in the Russell 2000 has been about 4% greater than those in the S&P 500. For earnings, that average beat is around 24.2% for the Russell 2000, only 19.1% average for the large caps, and a greater percentage of members in the Russell 2000 are beating estimates on the top and bottom line relative to the S&P 500. So it continues to be small caps world, John, and we're all just living in it.
What a rally it's been since late October. Kelly Lyons, thank you. Record high in the Russell, record high in the Nasdaq, record high in the S&P 500. The S&P, a tidy move through 3,900, up about 0.5%. Bank of America's Jill Carey-Hall expecting the small cap rally to continue. She writes the following: while we see potential near-term risk to equities, we continue to expect style rotations within the market in 2021, and would overweight small caps, which should benefit from a second half recovery. Jill, I'm pleased to say, joins us right now. Jill, great to catch up, as always. I spoke to Savita last week, and we started by talking about just the year-end price target. So, Jill, it's probably beneficial to the audience to start there, too. I imagine you're there in November coming up with the outlook for the back end of 2021, and 3,800 felt bullish at the time. And here we are, Jill, at 3,900. And I'm not here to criticize. This is a year-end call. We've still got 10, 11 months left, Jill. Just walk me through the thinking at the index level.
Right, great to be back. Thanks, John. So I think from a U.S. equity market perspective, you're right. We're not looking for index upside at this point. We have a neutral-ish call on equities with the S&P 500 year-end target of 3,800, and we're starting to see signs of more euphoric sentiment in the market. Our sell-side indicator, where we track strategists' average recommended equity allocations, has continued to tick up. So we're getting closer and closer to a sell signal on that. that. We're seeing other signs of, more euphoric activity in the markets. Large caps that have been beating on earnings this quarter have not been outperforming. Last time you saw that was around the market peak at 2000. So a number of signs where we would expect that the S&P 500 is not going to end the year, higher than current levels. And we think that there's more money to be made playing style rotations within the market this year, especially at the style in terms of value versus growth and at the size in terms of small versus large level.
So, Joe, you've nailed the small caps call. So let's sit on that. The story within the market, size and style. Let's sit on size just for a moment. Why stay with the small caps, Jill? Why the distinction between the call on the S&P you think will end lower than where we are right now and the call that you've got a bullish call on the small caps?
Right. Yeah, we turned positive on small caps in September. And even though you saw the best quarter ever for the Russell 2000, we still think it makes sense to overweight small caps this year. And, when we published our year ahead, we laid out a number of reasons why. But I think one of the key reasons is that if we're expecting an economic recovery this year, where our U.S. economists are looking for really strong 6% GDP growth, really the way that you want to invest in that is through small caps. There's a lot of differences between the S&P 500 and the U.S. economy, and small caps are closer to what the makeup of the U.S. economy is in terms of benefiting more from services. There's a lot of pent-up demand for services spending, more domestic, obviously. And when we've seen cyclical recoveries like this, typically that's when you see small caps outperform large caps. So, the recent inflows and outperformance that we've seen has been strong, but that's against a context of, multiple years of underperformance and outflows from small caps. So we actually think this could not only be a good year for small caps, but potentially the start of a longer secular outperformance cycle. Small caps have been underperforming since 2013. Usually these small versus large cycles can last about a decade on average. And even though valuations across the size segments are expensive, small caps are trading at multi-decade lows relative to large caps. So could be supportive if you're a long-term investor for small caps over the next 10 years as well.
So that's size. Talk to me about style. We're all quite familiar with the value growth tilt, the performance, the underperformance, the outperformance of the S&P 500 with the large caps, the mega caps, Jill. What's that look like in the Russell, in the small caps?
So we like value within small caps as well. Right now, when you look at value versus growth, we are seeing, similar to in large caps, pretty extreme valuation discounts for where value typically trades relative to growth. And if you think back to a number of months ago, a lot of the value-oriented sectors screened pretty poorly in our work. You weren't seeing the positive estimate revisions or the positive sentiment from fundamental analysts, but now that started to turn. So when we look at our work, we're actually seeing a lot of the value-oriented sectors within small caps, like financials and energy screening very favorably now in our work. And so we would overweight value, we would overweight cyclicals over defensives. Even though we're expecting a very robust GDP recovery, I don't think that cyclical sectors within small caps are really pricing that in. Even though the benchmark has performed strongly, you're still seeing the more cyclically oriented sectors as a group trading at very, very extreme, or in some cases all-time lows relative to defensive sectors. So still a lot of room to run on that rotation.
Jill, just a final question from me on the small caps and the increased participation that we've seen in the last 12 months from retail. I know you've been thinking about it. How are you factoring that into this call?
Look, I think, it's something that we're all going to be thinking more about going forward. It's certainly something that could create more elevated volatility within the index around certain names. When we've looked at, small caps with high short interest, you did see a very extreme reaction recently in terms of these small caps outperforming, driven by the retail investor-oriented activity. Typically, these stocks chronically underperform over the long term. So I think for a number of these stocks, we were expecting some sort of reversion to fundamentals when you looked at the small caps that were seeing some of this activity. But I think there's a lot of longer term implications in terms of demographics and the types of investors, a younger profile that are using some of these online platforms that don't have the same recency bias from being impacted by the tech bubble or other crises. So, that's something to think about going forward. And I think there's winners and losers. I think that, online brokers and exchanges can certainly benefit, but there's headwinds as well. If we start to see more money flowing into private markets, that could perhaps benefit alternative asset managers. There's regulatory risks. So certainly a number of avenues that the recent activity could have implications for.
Jill, always great to catch up with you and the team. Send my best to them, won't you? Jill Carey Hall there of Bank of America, thank you. Let's get some sector price action. What a morning already. All-time highs across the board. Here's Abby.
It is pretty extraordinary, John, so let's get right to it because it is, not surprisingly, risk on sector composition. It's all about the reopening in the reflationary trade. We have energy up top. We also have the banks up there. We have industrials climbing sharply higher. The two sectors that are lower, utilities and real estate, not doing well because yields are higher. Bullish, 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 John.
Abigail, thank you. Coming up on this program, the market-moving events you need to be watching. Chairman Powell coming up later in the week. We'll bring you the trading diary. Up next on this program from New York City this morning. Good morning. Your stock market, a record, a record, a record. Through 3,900 already this year. This is Bloomberg.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into this SPAC thing a little bit before it became such a hot method of going public.
Record and repeat all-time highs in the equity market. Let's get you the trading diary. The White House COVID-19 response team holding a briefing at 11. Cleveland Fed President Mester kicking off a busy week of Fed speak at noon. Fed Chair Jay Powell speaking Wednesday. US CPI coming too. Earnings through the week. Twitter, Lyft, Uber and Disney. And rounding out the week on Friday, University of Michigan consumer sentiment data. From New York City for our audience worldwide, all-time highs. I said rinse and repeat. Probably did that through the week. This was the countdown to the open. This is Bloomberg.
Do you have any interest if President Biden invited you just to come and take a tour of the White House just to see what it looks like?
If he wants to talk about how to empower people, boy, I would be there in a nanosecond.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
That's where they are right here.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
that moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
There's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it is widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC come to China, come to us, say, 24 people went for the job. 23 people accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你高。但是玩信息玩软的，中国的脑袋绝不比你长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
Be in love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it's served him well.